the market's resilience, and why it may soon end. Time and again, observers have watched in disbelief as financial markets have shrugged off crises that would have seemed catastrophic by any historical measure. A pandemic struck, and within 6 months, equities were back at all-time highs. Inflation reached levels unseen in half a century, and within a year, markets had recovered. A trade war upended the post-World War II global economic order, and within 3 months, indices were setting new records. Now, with a conflict in the Middle East disrupting oil supplies, markets have once again proven their seemingly supernatural ability to bounce back within weeks. For 15 years, this pattern has repeated with remarkable consistency. Every correction was met with aggressive buying. Every crisis was absorbed. And investors grew accustomed to a world where dips were simply opportunities in disguise. But that world may be drawing to a close. The disconnect between Wall Street and Main Street. Over the past 12 months alone, the S&P 500 has gained more than 50%. Real GDP growth during the same period measured roughly 2.5%. And with oil prices now climbing on the back of the Iran conflict, some economists are revising that estimate down to between 1.2% and 2% annually. This kind of divergence is not without precedent, but it is historically unusual. Between 1998 and 2011, the S&P 500 delivered an average annual return close to zero, even with GDP growth at comparable levels. Similar stagnation characterized the stretches between 1973 and 1980, and the prolonged 24-year period between 1929 and 1954. During each of those eras, the stock market tracked the broader economy rather than racing ahead of it. So, what changed? How corporate America defied gravity. A closer examination of the data reveals something striking. Over the past 15 years, through a European sovereign debt crisis, a global pandemic, a Russian oil shock, an unprecedented trade war, and now the closure of the Strait of Hormuz, corporate profits have grown in near-perfect lockstep with the S&P 500. This is not illusory growth. Equity prices have been supported by genuine earnings expansion. The puzzle, however, lies in what corporate profits have grown against. GDP grew at less than a quarter of the market's rate. Real personal income, what ordinary workers take home, grew at roughly a tenth of it. Warren Buffett once observed that it would take wild optimism to believe corporate profits could sustainably hold above 6% of GDP. Today, they sit at 12%, double that threshold, and have remained elevated for well over a decade. Why does this matter? Because, historically, two powerful forces have kept corporate profit margins in check. The first is competition. When margins expand dramatically, new entrants flood the market, undercutting prices and compressing returns until equilibrium is restored. The second is what economists call the negative feedback loop. When corporate profits consume an outsized share of GDP, wages shrink in relative terms. And since workers are also consumers, weakened purchasing power eventually translates into weaker corporate revenues. The Federal Reserve, the engine behind the machine. The mechanism that has allowed corporate profits to defy these historical constraints is, in large part, the United States Federal Reserve. Each time a significant economic crisis has emerged, the Fed has responded with the same toolkit: interest rate cuts and liquidity injections. These measures flow through the banking system and disproportionately benefit large borrowers, which is to say, large corporations. Crisis after crisis, capital has flowed toward corporate balance sheets, bolstering profit margins while wage growth for the average worker remained muted. As the U.S. Treasury Secretary has noted, the Fed functions, in effect, as an engine of inequality. This dynamic was only sustainable in one specific environment: Low inflation. Through the 2000s and 2010s, core inflation in the United States remained comfortably below 3%. That gave the Fed the latitude to act aggressively, slashing rates to zero after the financial crisis, repeating the playbook in 2020, and providing a consistent backstop for corporate America at each inflection point. That environment has now changed. A regime shift in the making. Core inflation has risen sharply and remained stubbornly elevated, reaching levels not seen since the 1980s. The Federal Reserve, constrained by price pressures, has been unable to deliver the rate cuts that markets have come to expect, even as consumer confidence has hit record lows and GDP has printed weak on multiple occasions. There is now a credible scenario in which inflation remains persistent and the Fed is forced to raise rates before year-end. Should that occur, the cushion that has protected corporate profits for 15 years would be abruptly removed. The same mechanism that precipitated earnings collapses in 2008, in 2001, and repeatedly through the 1970s. This does not mean a wholesale retreat from equities is warranted. Markets could remain buoyant or even continue rallying in the months ahead. But investors who fail to prepare for significantly higher volatility risk becoming part of the 90% who historically sell at the worst possible moment. Where the opportunity lies. Analysts at Bravos Research have identified specific sectors that are well positioned to generate strong returns in this kind of environment, and have concentrated roughly 80% of their model portfolio across just 10 stocks within two key areas. The first is biotechnology. Breakthroughs are accelerating. Capital is flowing in at an unprecedented pace, and the sector has already outpaced the S&P 500 by 80% over the past year, with analysts believing significant upside remains. The second is base metals mining, a sector that has outperformed the broader market by over 100%. Base metals are foundational inputs for electrification, data centers, and the physical infrastructure underpinning the current technology boom. It represents, in the view of these analysts, the AI trade that most investors have overlooked, one that stands to be further accelerated by persistent inflation and the trend toward deglobalization. For investors willing to look beyond the headline indices and position accordingly, the volatility ahead may not represent a threat, but rather the opening of a generational wealth-building window. That's all for today's video. Now, if you are a complete beginner and want to learn about investing in stocks, my go-to recommendation is always The Intelligent Investor by Benjamin Graham. You can get a link in the description where you can get a free audiobook version of this book with a trial. Definitely worth trying. Thank you for watching.